In the future, will taxes be higher or lower? This is a question I ask clients on a daily basis. What do you think? In the future, do you think taxes are likely to be higher or lower? If we ask David Walker, he was the Comptroller General of the United States through both Clinton and Bush. He actually went on national radio and said that taxes must be higher in the future. And there's a four-letter word that is the reason that that is the answer to that question. And the answer to that four-letter word is math. He talked about the national debt that our country was facing, not even just the extreme spending, but the debt that he was facing. I want to share with you what that debt looks like. This is the U.S. National Debt Clock. You can check it out at usdebtclock.org. And this shows you our live U.S. debt. Right here, some of the most important words. We are at a $36 trillion national debt. That's $107,000 per citizen. That means all of your children included. Each of them would owe $107,000 or $271,000 per average taxpayer. And this $36 trillion is just the start of this problem. We are having an additional $2 trillion currently added in deficit spending every single year. But this national debt does not include all of our debt. Some additional debts that need to be included are Social Security and Medicare. This is another $27 trillion in Social Security, meaning we need $27 trillion today in the Social Security funds to properly fund Social Security the way it's said to be funded. And Medicare, we need $42 trillion to be able to fully fund Medicare the way we tell people it's funded right now. And if you take a look at our complete unfunded liabilities, including our national debt and all other debts and promises that our government has made, we have a $221 trillion total debt and unfunded liabilities. You can actually cover over this right here. It says total U.S. unfunded liability up at the top includes Social Security, Medicare Part A, B, and D, federal debt to the public, plus federal employee and veteran benefits. These are based on generally accepted accounting principles, or GAAP, and the source of this information is the U.S. Treasury. So we have $221 trillion in debts and unfunded liabilities as a country. Regardless of what things happen, that debt must be taken care of. And one of the only ways the government has of getting money is by taxing its populace, the citizens. So, in the future, do you think taxes are likely to be higher or lower? This is why we're going to talk about how important it is to actually have a plan in place and a properly designed plan. When it comes to taxes, there's certain age milestones that matter. At 59 and a half, you're officially old enough to be in charge of your own money. Uncle Sam says you're now allowed to take money out of your IRAs and 401ks without additional penalties. And by age 73, they say you're no longer old enough to make your own choices. You now must start withdrawing money because the government is partial owner of your IRAs and they're ready to get their checks. So you now must start taking money out of your account in the form of RMDs. So we have a client here who they're currently age 60 and they want to retire around 67. We need to understand their taxes. And when it comes to understanding their taxes, we need to understand their income. So currently they're making about $140,000 a year as a married couple. And in the future, they don't have any pensions, rentals, or anything else that's going to provide them income except for Social Security. Social Security, they're both going to get about $25,000 a year, which is a total household income of Social Security of about $50,000. So now that we understand their income, we need to understand how the taxes work in our country. The way taxes work in our country is what we call a graduated tax system. Maybe you remember from biology that little tall cylinder some people thought of as a beaker. It's called a graduated cylinder. What happens here is you pour your money in the top and slowly it starts to fill this up. Your first money's taxed at 10, then 12, 22, 24, 32, 35, and 37, finally when you get to the top of this tax bracket. Everyone pays some taxes at 10%. Even Elon Musk pays some taxes at 10%, and then very rapidly, as he fills up the cylinder, he gets up to the top tax bracket in our country. We are all in the same place where some of our money is taxed at each bracket as we move up in the system. Now, when it comes to this, there's only three ways to save your money or invest your money. I'm going to refer to these three things as buckets or three lenses through which the IRS views our money. So the first bucket is what we're going to call the taxable bucket. The taxable bucket is very, very simple. It's taxed every year, not only when you earn it, but every year as the money grows. Some examples of this: checking accounts, savings accounts, stocks, bonds, mutual funds, CDs. Every year you earn interest on them, you actually have to pay taxes on the interest you're earning. How do you know you have one of these types of accounts? You get at the end of the year a little love letter that says it's a 1099. It says, congratulations, you made money, and the IRS feels like it made money too. You can send them their portion in the form of a check. right? That's how they're collecting taxes off of these, is through those 1099s. So if the growth is taxable on this money, you have to pay taxes when you earn it, and every year as it grows, what's the benefit of having these types of investments, checking savings, and these types of investments? It's that it's liquid. You can access the money, and this is a perfect location for money that you need liquid access to. It's an emergency fund source. So when you take a look at this, we typically recommend you keep 3 to 6 months worth of liquid money in an emergency fund. Now, can you have too much money in this bucket? A lot of people say, no, I could never have too much money in the bank. I love having money in the bank. But if you actually have too much money in the bank, you're actually creating a tax liability that can cause you to pay taxes. So what we want to be able to do is have enough money in this bucket to be able to handle emergencies without having so much money that it causes a tax liability we don't need to. And that's the moral of the story for this bucket. The second bucket that we get to take a look at, well, let's talk about our clients here again real quick. So they have in their checking account 20,000, 20,000 in savings, and they've got a brokerage account of about $200,000. Bucket number 2 is called the tax deferred bucket. This is probably the most popular bucket in America. There's no 1099s. You don't pay taxes now. When do you pay taxes on this? When you take the money out. Some examples are all the 401ks, IRAs, and all the other IRS tax code investment vehicles that allow you to save the money. All of these accounts have different rules, but they have 3 things in common. The 3 things they have in common is, first off, you get a tax deduction for putting money into it. If you make $100,000 and you put $10,000 into one of these accounts, you now only have to claim $90,000 on your income this year. Everybody loves getting that tax deduction because they don't have to pay taxes. Now, if you think taxes are lower now and they're going to be higher in the future, how much sense might that make? It depends on your specific tax situation. The next thing that these all have in common is there's a special way they're treated when the money comes out. That money is treated as ordinary income when it comes out. Basically, you're just deferring the time you take this income to some point in the future when you may or may not be able to handle taking the taxes on that money. And the biggest problem with this is that you enter a business partnership with the IRS. Imagine for a second you've got a business that's worth a lot of money, and say it's worth $1 million. Your business is worth $1 million. But the government gets to vote every single year on what percentage of your business they own. Right now, maybe they only own 22%. But in the future, they decide that they need more money and they now own 40% of your business because they voted that they deserve 40% of your business, and there's nothing that you can do. That's a bad business partnership, right? So if you have $1 million in your IRA, but you don't know how much the IRS is going to keep from you when you actually get to that point, is it really hard to plan for how much money you're going to have in the future? This is one of the problems that we have with an IRA, is that you don't know what you're going to have in the future, which is called tax rate risk. It's the same as taking a stock market loss. You can't control it, but you have less money in your account, but it's a function of tax rate risk. The last thing that we know about these types of accounts is we will eventually have to pay taxes on this money. If nothing else, by age 73, when we have to take RMDs or when we pass the money on to our heirs, eventually the taxes on these accounts must be paid. So in this example, our clients have a 401k with about 200 grand in it and an old IRA with about another $200,000 in it. This brings us to the third bucket. We like to call this the tax-free bucket. Is it truly tax-free? We pay some taxes on it now, but we don't pay taxes in the future. In order to qualify to be in the tax-free bucket, your investment must truly be tax-free. That seems like a no-brainer, but there's some things that pretend they're tax-free that aren't. In order to be truly tax-free, you must be free from federal tax, state tax, and capital gains tax. Municipal bonds are one of those things that tout the fact that they're tax-free, but they might not actually be tax-free. If you get a basket of muni bonds or a muni bond in a different state, while it is always free from federal tax, it may not be free from state tax in the state that you are in, and could also have some consequences in a fund of capital gains tax. So while it is free from some of these taxes, it's not always truly tax-free. In addition to this, we're going to talk about no Social Security taxation. Municipal bonds also cause taxation on your Social Security. Now, this is something a lot of people didn't realize. Did you know that your Social Security could be taxable? Some people say yes, some people say no. And that leads us to the second question. Did you know that your Social Security does not have to be taxable? That you could get your Social Security and pay no taxes on it? Most people know one answer, but not the other. And it's surprising which way those tend to go. So if in order to be tax-free, whatever money comes out of this tax-free bucket cannot affect the taxation of your Social Security. And there's tax structure has to be no taxes on growth or on distributions. There's only 2 things that actually fall in here, and those 2 things are anything with the word Roth in front of them, Roth IRAs, Roth 401ks, etc., or certain types of cash value life insurance, if designed correctly and following certain IRS codes, those can also be tax-free. These clients, like most clients that we work with, have little to nothing in the tax-free bucket. So when we take a look at these three buckets, we take a look at how the money comes out, and we want to focus on this no Social Security taxation. Now, this is a whole thing about will there be Social Security, will there not be? We're going to talk to you about how the rules are written today for Social Security. So there's a dirty little secret when it comes to Social Security, and that dirty little secret is called provisional income. This is a number that the IRS tracks to determine if they're going to tax your Social Security or not. And so here's what goes into that provisional income number. Anything that comes out of your taxable bucket with the 1099s, the growth, that counts towards your provisional income. Anything that comes out of the tax deferred bucket in the form of distributions, those count as provisional and ordinary income. Anything that comes out of the tax-free bucket has to count as zero because that was one of our rules for it being tax-free. Then any pensions or rental properties you have count towards this income. And then this is the worst one. 1/2 of your Social Security, in this case, $25,000, go towards counting whether your Social Security is going to be taxed or not. Now, these numbers have not been updated since the 80s, but the provisional income limits are if you're a married couple filing jointly and you make up a $44,000 a year or more of provisional income, up to 85% of your Social Security becomes taxable at your highest federal marginal tax bracket because it's the last money that is going to drop into your thing. So if we take a look and say you're in the 22% tax bracket, 85% of $50,000 is $42,500. That is the last money to drop into your bucket, so it's being taxed at 22%. So if we tax $42,500 at 22%, what that actually looks like, well, and then we have a state tax here of 3%. Not all states charge state tax, but we're just going to take a look at this. That is a Social Security deficit of $10,000. That means you've got 42, but you have to give $10,000 of it to Uncle Sam. So you really only got to keep 32 of that 42. So of the $50,000 you're supposed to get a year, you were actually only getting $39,375. You have to write a $10,000 check to Uncle Sam if you have to pay taxes on that Social Security. So what if we could eliminate that tax? What if you didn't have to pay that? What if instead we could leave that money in your own accounts because you're not having to make up that income gap, and we could let that sit in a tax-free account and grow tax-free for the rest of your retirement? That's $10,000 a year. So the way we figure that out is pretty simple. All we've got to do, went too fast, is calculate two questions. How long do you think your retirement is? And what's a reasonable rate of return? So we're getting $10,000 every single year. So if the average person retires at 65 and they live for 30 years in retirement, that makes it a 30-year retirement. And so what is an expected rate of return? Is 6% a reasonable number? So if we add $10,000 a year for 30 years to an account, averaging 6%, the future value of that account would be $839,993. So almost $850,000 of additional money in your retirement if we don't have to pay this $10,000 in taxes every single year. This is one of the powers of maximizing our tax-free distributions. Now, what it takes to get there may or may not make sense for each individual client, but what we want to really focus on is the idea that, again, the more that we take this provisional income and the more we shift money from the taxable bucket and the tax deferred bucket towards tax-free, so the more we go from left to right, the more we win. The more it goes from right to left, the more the government wins, which RMDs force you to take money out of the tax deferred bucket and shift it to the taxable bucket. We want to shift money into the tax-free bucket to minimize those overall tax liabilities, minimize taxes on our Social Security. So how exactly do we go about doing that? There's a number of strategies that we utilize. There's actually 6. And the first one is the Roth IRA. So you're able to contribute money to this, but how much can you put into a Roth IRA? $6,500, $7,500 a year. And that's only assuming you don't make too much income, because if you make too much income, the government actually tells you you're not allowed to have one. So it doesn't really allow us to put enough into it, but it is the first strategy we implement and look at for our clients. The second strategy is the Roth 401k and the Roth IRA. What's the benefit that this one has over a Roth IRA or in addition to a Roth IRA? First off, there's no income limit. Doesn't matter how much money you make, you can put it into it. Also, you can potentially get an employer match. Maybe you have a Roth pension or something else where it can get you larger sums of money to be able to do something and get it into here tax-free in a larger dollar amount, because it's not $7,000 here, it's almost $25,000 here. That's the limit on this plan. Each of these plans have pros and cons, and we take a look at each of those for our clients. Now, number 3 is the Roth conversion. This is typically the workhorse for the bulk of our clients in this client here in this example. What a Roth conversion allows us to do is take an unlimited amount of money from the tax deferred bucket and put it into the tax-free bucket. Now, we don't want to do this all at once, because if we do this all at once, we'll actually shoot to the top of the tax brackets and pay more in taxes than we need to. So how do we decide to do this? We want to do it quickly enough that we can do it before taxes go up. Now, when would taxes go up? We're in a unique place. As of the time I'm recording this video, the law currently states that the Trump tax cuts will end January 1st, 2026. Now, Trump was just elected, but he has not yet been inaugurated, and he wants to lower these taxes again. But even if he lowers taxes, Trump is only going to be in office for 4 years. And no matter what Trump does to taxes, we still have that math problem that David Walker told us about, all those unfunded liabilities and national debt that must be taken care of. So maybe we have a little bit longer to take care of this taxes and a little bit of time to take advantage of currently low tax rates. But eventually, do you believe taxes are likely to go up or not? As it's written into law today, which is all I can talk about, is January 1st, 2026, taxes are set to go up. So we want to move it as quickly enough that we can get the money converted before taxes go up, but slowly enough that we don't shoot to the top of these tax brackets. So what's that deciding factor? It depends on how much money you have in each of these buckets and how much we need to move from one to another in order to get our provisional income and our taxes down. So that's how we decide exactly how much we need to move in a year based on your income, your assets, and a couple of other things that we're able to work with our clients on. Now, this is the holy grail. Wouldn't it be the best if you could have a perfect investment where you got a deduction for putting money away, you didn't pay any taxes as it grew, and you were able to pay tax, and you didn't have to pay any taxes when the money came out, right? That sounds perfect. That's actually an IRA. Now you might go, I thought that was a tax deferred bucket. So the secret is that there's actually a perfect amount that you want to keep in that tax deferred bucket. If you have a specific amount in your tax deferred bucket, where say the only amount of income or RMDs you're forced to take out are say $24,000 a year, you can offset that as a married couple filing jointly with a $24,000 standard deduction. So if your only reportable income is $24,000 of income coming out of an IRA, and then you take a $24,000 standard deduction, your new income reportedly is now zero. So you didn't pay, you got a deduction for putting it in. There was no taxes as it grew. And when you pulled it out, since you're able to offset it with deductions, you're actually able to pay no taxes on that money going forward. So there is a correct amount to keep in this bucket. It's just a matter of calculating exactly how much that amount is. Now, if you have a pension or a rental property or any other stream of reportable income, the correct number may be zero for you. But if you have no other reportable sources, then a tax-free IRA is actually kind of the holy grail of investments. Now, after we've taken care of all these other ones, we take a look at a private reserve account, a LIRP, a life insurance cash value insurance policy, whatever you actually want to call that plan. And what that is able to do is we're able to take an unlimited amount of money from the taxable bucket and shift it into the tax-free bucket. So we're calling this a private reserve account. It could be a life insurance retirement plan, an infinite banking strategy. All of these fall under a life insurance strategy. So these life insurance strategies have the similar rules to retirement accounts, but they're actually very different in a few specific areas. The first thing is that there's no penalty for taking money out at any age. There's no 1099s, meaning every year as this money grows in this account, you don't pay any taxes on the money. You don't have to even report it. This is a big one. There's no contribution limits. It's one of the only retirement accounts with no contribution limit. We have clients who do $1 million a year into these types of plans because there is no limit to the amount of money you can put in. There's no income limits. Unlike a Roth IRA, where if you make a certain amount of money, you cannot contribute, there's no limit to the amount of income you can make and have one of these types of plans. There's no taxes on the money when you take the money out of the plan. And lastly, there's no legislative risk. A lot of people say this sounds too good to be true. What happens when the government figures out that this is the way it is? Truth is, the government found out about these plans in the 70s and the 80s. E.F. Hutton, he's a guy, maybe you've heard his name. When E.F. Hutton speaks, people listen. He's the guy who found this loophole. And what he was able to do is he went to the Rockefellers, the Kennedys, and the very wealthy and the elite of the country and showed them how to put money in this. So in the 1980s, the IRS caught wind of it, in which the government said, we need to change some rules on this. And so they actually passed 3 new laws in 82, 84, and 88. They passed TAMRA, TEFRA, and DEFRA. And those effectively put some limits on the life insurance, but those limits are different than an IRA or a 401k where there's a hard line of this is how much you can put in. They put a formula in place to say, this is how you can buy insurance. And if you buy this much insurance, you can put this much money away. So they allow us to control what we want to do through the life insurance that we purchase. And every single time they pass one of those new laws, they created a grandfather clause that says, if you had this type of plan before the law was changed, you get to keep this plan under the old rules. And so they haven't changed it since 1986. 1988. And if they were to change it again, likely they would include a grandfather clause, just like they have every single other time. Now, these types of life insurance plans are ideal for people who have a lot of money in the taxable bucket and don't have any other way to get it to the tax-free bucket after we've completed the other strategies. They're great for some people. They're not great for everybody, but it is one of the strategies we look at specifically for people with a lot of money in the taxable bucket. Once we do this, we pay no tax, no tax, no tax, and no tax. Then we don't have any provisional income. And so that means our Social Security is now no tax. So when you have no tax, no tax, no tax, and no tax, what is your effective tax rate? Your effective tax rate is actually 0%. And when you have a 0% tax bracket, we don't have to worry about taxes going up. So here's the key takeaways. January 1st, 2018, taxes went on sale. What happens when tax rates rise? Your accounts effectively go down by the same amount. Social Security taxation forces people to spend down their accounts because in order to make up the $10,000 we have to give to Uncle Sam in this example to pay for taxes, we have to get that $10,000 from somewhere else then to make up the income that we needed. So it spends down our accounts much more rapidly. So what tax rate would you prefer? Would you prefer a 0%, or would you prefer a 22, which will become 25 as of 2026, or 24, which will become 28 or 33? And even if we can't get your Social Security tax-free, it still makes sense for us to take advantage of this mathematically, to take advantage of these low tax rates on our IRAs and other assets to shift them while taxes are still historically low. I hope this has been useful for you guys to really understand a little bit more about how these tax systems work and what types of plans we can put in place from a tax perspective. Now, these must couple still with an investment strategy that makes sense for you and your financial situation currently. And all of these things need to be adjusted every single year as tax numbers change. So this is not a plan that you put in place one time and you're done. It needs to make sure that it is updated on an annual basis with your advisor. And often we work with your CPA to make sure that we really understand how these things work together.